Welcome to the lecture today. So today I first want to talk a bit about the term project. Okay? Most of that is what you already know, but there is some new information in these slides. Okay, after that we will talk about Unit 5, Capital Market Equilibrium. So this is about the term project presentation. So this is the deadline. This was communicated previously. I will put those slides on Moodle this evening. Okay? So I just want to show them first, and then I put them on Moodle so you will have all this information. The deadline, April 16, midnight. Okay? So we are relatively quickly approaching the, let's say, the later part of the semester, which means that also the deadlines are coming up, so please keep that in mind. The presentation for your term project, that will be a pure offline face-to-face presentation in the second last week of the semester. Okay, so remember I talked about that before. The reason for doing it in the second last week is really that in previous years, student feedback often was that like there is too much happening in the last week of the semester and then preparing for the exam. So yeah, I try to do it a bit early. Okay? So this is new. We have multiple time slots for the presentations. Each time slot is 60 minutes. 5 groups per time slot. Okay, so we have in total 8 different time slots distributed across 3 days. Monday, April 17, Tuesday, April 18, and Wednesday, April 9. Okay? So, 6 p.m., 7, 8, yeah, you can read that. Okay? Venue is KK315, so it's just one floor. 2 floors. Each group, so these are 60-minute sessions. There's 60-minute sessions, 5 groups per session. Each group attends the whole session. That means if your session is 6 p.m., you arrive 5 minutes before 6 p.m., you're expected to stay until 7. There is no leaving and going and whatever during the session, because we need to concentrate on it. You are free to choose whichever of these sessions you like best. And from Monday, next Monday, April 3rd, you will be able to book one of these sessions. Sign up, first come, first served. So this will be on Moodle, it will be online on Monday. Okay? Just to make our life not super difficult, just please make sure that every group signs up only once. Okay, so every group now please talk today, Saturday, Sunday, which time slot you as a group want, what would be possible, what would not be possible. And then only one representative of the group will sign up for the slot. Okay? No double bookings, please. So first come, first serve. We have 3 days, it's relatively late on these days, so I'm quite confident that we will not have too many conflicts with other lectures before you. Okay? So that's important. Monday, the sign up will be possible, so keep that in mind. Okay? Is that clear? So that's the organization of the presentation. Okay? Yes. No. Every session is 60 minutes, so you have to attend the whole time slot. Okay? So, like if you choose the 6 p.m. time slot, 6 to 7 is one time slot, 7 to 8, 7 to 8 is okay? So and obviously you only have to attend your own slot. Okay? Good. Presentation structure. Also some remarks. Something that I would really like you to do is to introduce all group members. So when you start a presentation, just state your names, or one person says, this is group, I don't know, these are my group members, A, B, C, and D, and my name is. So that you know who is actually talking. And that would be very helpful for us. The presentation time is 8 minutes straight. Okay, it's exactly 8 minutes, followed by a quick question and answer session, but the Q&A is typically, Jason will attend all the presentations and I will attend all the presentations. So typically it's like me and or Jason asking one of the questions. Okay? So the 8 minutes we have to be quite strict because we have 60 minutes now in 5 groups. We need some time to set up and leave and so on, so we have to be relatively strict with the 8 minutes. Okay? So 8 minutes, then there is a grace period of, I don't know, 30 seconds or so, but then I will have to stop. No matter if you're done or not, after 8 minutes, 30 seconds, out. Okay? So please, make sure that you finish in 8 minutes. Practice, train, I think that's very doable. Okay? During your presentation, during those 8 minutes, we will not ask any questions. So this is really your time, and you can really practice that because there will be no interference or questions now. Yeah? Then I also said earlier, all group members must, in some form, participate in the presentation. So all group members must have some active role. How exactly you do that, up to you, but all group members must have some. Yeah? So then a little bit about the content of the presentation. So obviously the presentation shouldn't just be the report, right? I mean, 8 minutes, there is no way you can present your whole report. The presentation should give an overview on the report, highlight the most important aspects. It is not necessary, and it is not encouraged to present everything you did in the report. You can at all times in the presentation say, look, we did a DCF, this is the outcome, this is the basic idea we used, but if you want to know the details, please look at our report. That's perfectly fine. You don't need to give all the details in the presentation. So it's more important to deliver a clear message. To tell investors what to do. Is this stock good? Is it bad? Buy, sell, neutral? Why? Deliver a clear message and do not get lost in too many technical details. That will be hard for the audience to comprehend in real time. Okay? So this is the presentation structure. The report, here again, most of that, I think nearly all is already the same as what was announced before, just to make sure everyone's on the same page. Same deadline, Sunday, April 16 midnight. So 2 weeks and 3 days from now. 2 days. 3 reports. All reports should be self-contained and independent of each other. So I don't like it if report A says, oh yeah, the industry comparison is the same as report B. Stop. Then I have to look at report B, and then it kind of becomes like a circle. You have to look through multiple reports and you get completely lost. So every report should be self-contained. But, of course, you can use the same parts. For example, industry overview. You can use exactly the same thing for all 3 reports. You just copy it 3 times in every report. Okay, that's perfectly fine. But every report should be understandable by itself. Approximately 4 pages, plus minus 1 page is perfectly fine. If you have like a cover page, that will typically not count. You can add an appendix that will also not count to that limit. Okay? What you can do, but you do not have to do that, is to add at the beginning of your 3 reports, when you submit them, and submit them as a single PDF, for example. And at the beginning, you have an overview where you write, look, we have 3 reports about 3 companies, and this is our main result, or something like that. You can do that, but you don't have to. That's really up to you. That would not count in the page limit. The final target of the report is really to come up with a buy-sell neutral recommendation that is as convincing as possible. And I know it's not something that is super helpful, but how you do that is really up to you. There are multiple ways to do that, more qualitative, more quantitative, different sections. We talked about that a bit. So it's really up to you. It depends on your preferences and on your industry. So the only thing that I normally say is that the valuation part is an important aspect. It's typically very hard to come up with a clear recommendation if you have no valuation model. Okay? So, but whether you do it more quantitatively or more qualitatively, this is really up to you. And I always like to say, I mean, I have seen many of these reports in the last years, and I have seen excellent qualitative reports, and I have seen excellent quantitative reports. Okay? But the opposite is also true. I've seen bad qualitative and bad quantitative. So whether you do it more this way or more that way, this really has no predictive power on how great your project will be. Okay, so this is the structure, kind of what I expect you to do: reports, presentation. So the real new information for now is Monday, sign up for the presentation session. Okay? Everything else, I will upload it, you go through it, but there's nothing. I think most of those things are not really unexpected. Okay? Any questions so far? No? I have a few questions, frequently asked questions that I want to clarify, that I want to go through very quickly. So this is not from this year, this is like really over the past few semesters. Questions that often come. So which section should we include? I don't know. This is really up to you. It is your task to produce a report that delivers a convincing buy-sell neutral recommendation. How you do that is up to you. The only kind of restriction or strong recommendation would be evaluation. Okay. Can we use different valuation models for the 3 different firms? Yes, you can. It is not a requirement to use the same valuation model for all 3 firms. You can do that, but you do not have to. You can use 3 different models, you can use 1 model for all firms, you can use 2 different models, whatever. And so there is no restriction. What is the most appropriate valuation model? So this is a very big question, and I don't have a super good answer to that. There is a bit of a guideline, rule of thumb thing. I mean, if you have very young companies, no dividends, no stable cash flows, typically people use 1. If you have more mature firms or established firms that do have stable dividends, you can use dividend discount. If you have more mature firms without stable dividends, typically people use DCF. Okay? This is a rule of thumb, this is a rough guideline. You are always very welcome to deviate from that here. You can do whatever you think is the most appropriate. And you just explain what you do, and it will be fine if there is a reason for it. This is just like a rough guideline in case you are completely lost and cannot decide before. How can we calculate dividend growth and future cash flow? Again, I have no simple answer to that. You will have to make a lot of assumptions. Don't be afraid of that. That's part of the game, in some sense. That's part of the learning experience, that all valuation models require a number of assumptions, and the results will be somewhat sensitive to these assumptions. Deal with this uncertainty in a very offensive way, stated, don't try to hide. That's perfect, that's not your fault. It's perfectly fine. Okay? So you make assumptions, you explain them. As a general approach, there's like a two-step procedure that many analysts like to do. First, you use historical data, and you try to make some technical predictions based on these historical data. And really a trend is the simplest one, but you can think about more complex ones like AR, MA models, or whatever. You just try to do some time series prediction, okay, based on past data. This is step one. And then step two would be you adjust those predictions based on your expert opinion on it. Like, let's say you do that for Tesla, so you use historical data, you make some prediction, but then you adjust all the predictions a little bit downwards because your expert opinion is that there will be much more competition from new electric car manufacturers. Okay? That's it. Good. How should you show the calculations, like, for example, how to calculate beta? It is not necessary to show all the details in the reports. You do not have to attach screenshots or something like that. Just be clear, explain what you do, be clear about what you're doing. What is the time frequency you're using? What is the time period that you're using? What are the data sources? Be clear. But I do not have to see exactly how you do it. That's fine. You are, however, welcome to add this Excel spreadsheet that you use for your calculations to your submission. Okay? You don't have to. That's up to you. Kind of the advantage if you do that, I mean, if I read the reports, and I find something very unbelievable or very strange and it's not very well explained, I mean, then I have to say it's kind of bad, right? But if I can look at this spreadsheet and I understand what you're doing and it's just like my misunderstanding or the description was not perfect or something, it kind of helps for me also to appreciate more what you did. Okay? But again, this is completely up to you. You can submit the Excel spreadsheet if you do make sure it's kind of understandable what you're doing. You don't have to be super careful about formatting or stuff. It should be understandable. But this is your decision. You don't have to submit those. Okay?
Don't mix the pricing from multiple model and then try to find a value between them.
Say that again. You mix the price from different models?
Yes, and then we can find a value between them.
Yeah, sure. You can be as creative as you want. I appreciate creativity and I do not place any restrictions on that. Okay, so you can use 3 models per firm, you can use 10 models per firm, and like same models with different assumptions, then it's all up to you. Okay? Some assessment criteria, because that question also often comes up, how do we assess things? Yeah, so I think, yes, again, most of that is clear, like the presentation, what are we looking at? Fluency of the presentation, how well the slides kind of help to understand what you're saying, how well your presentation helps to understand the slide. Generally, that you convince the audience that you are an expert in this topic, you know what you're talking about, and generally also that you do it in a professional way. And professional way, I mean things like time management. I mean, again, you have 8 minutes. There is no interruption from me, Jason, or anybody else, so you can practice and you should be able to finish in 8 minutes plus 15 seconds. Okay? Things like coordination among team members. Again, this is purely practice. If you practice your presentation 2, 3, 4, 5 times, I mean, everybody knows what to do at which point of time. If you do it for the first time here, I mean, there will be a lot of, you will feel that this is not very professional. Right? Nobody knows what to do and things like that. So this is really only about practice. All the fluency is a lot about practice. Analyst reports, yeah, of course, I mean, the content should be accurate. That's kind of clear. How clear the content is in the sense that if I look at your recommendation and then I read your report, do you really understand why you end up with this recommendation, or is this like totally unclear to me? So is there like a stringency in your reports? Do you end up with a clear conclusion based on arguments you made before? Yeah? Clear explanation. And then, so this is kind of the content part, but then there is also like a part of how much time you put into that. And that is of course also important. Yeah, design and layout. I mean, it doesn't have to look like a professional report, but yeah, it should at least be consistent. Yeah, and it shouldn't look like you did it in 5 minutes. Let me put it like that. A clear structure, and also a common theme throughout the report. So it's typically not very professional if you have 3 reports from the same analyst group, and they have 3 completely different layouts and structures. Of course, you can use like there's different text, and like valuation model can be longer in one report than in the other. But I mean more things like same font size, same optical style, things like that. Same basic structures. Okay? So again, those are things that are related to how much time you put in. Okay?
What type of questions should we expect?
Very difficult. No, I mean, mostly like clarification. Like if you present something and you say, oh look, I don't know, this stock is better than this stock because we think that there will be more competition for Tesla in the future, and then I could just ask, well, why do you think there will be more competition? Or you say, we make assumptions for the DCF, but that's it. I mean, which would be kind of fine for the presentation, but then I could ask you, like, could you explain the most important assumptions briefly that you make?
How much time do we have?
Presentation is 8 minutes, yeah, and then we can approximately 10 minutes per group. So, right. Okay, so be brief in your answers. I will not ask questions where I expect like a 5-minute speech. The questions will be able to answer them in like relatively short. Okay, so I typically one. There is no official dress code, so you just do whatever you feel comfortable as a group, and yeah, I don't place any restrictions. Okay? Any other questions? Good. So that's all. Again, I will upload that tonight to Moodle. So, chapter 5 or unit 5, capital market equilibrium. The first part will be the capital asset pricing model. Yeah. So let me just make one quick remark here. Unit 4, which we did last week, was about equity valuation. Okay? I have slightly adjusted unit 4. I have re-uploaded it in the sense that I removed the other 2 subchapters of unit 4 from unit 4, and I moved them to unit 6. Everything we did last week, equity valuation, is 100% unchanged. So everything is the same. The 2 other subchapters we have not yet talked about them. So I just moved them to unit 6. Because I think it's better to now directly talk about the capital asset pricing model, because it's very much related to equity valuation. And you will actually apply that when you do your valuation. Okay, so just for your information. So this will be unit 5, capital market equilibrium, capital asset pricing model, arbitrage pricing theory, and then we'll talk about market efficiency, and then we will have unit 6, which is more about practical aspects of it. And that's it. end of the semester. Good. Capital asset pricing model. The capital asset pricing model basically starts where the Markowitz portfolio theory ends. So Markowitz says that people choose kind of optimal portfolios under some assumptions. Yeah? But Markowitz only thinks about individual people. And Markowitz only thinks about what is the optimal portfolio choice for me and for you and for everyone. Markowitz portfolios selection theory does not look at the aggregate effects that this could have in the market. It's not an equilibrium. It's just an individual portfolio optimization. This is what capital asset pricing model does. Capital asset pricing model now goes one step further and basically says that, look, if all people behave as Markowitz expects them to behave, how would the overall capital market look? In equilibrium. An equilibrium here means that a market is in equilibrium if everything is stable. If I look at the market and in this second, this nanosecond, nobody's trading, everybody's happy. Supply equals demand for all the assets, everything is balanced. Of course, in the next nanosecond that can change because there is new information, but in one point of time, everything is balanced, everything is in equilibrium. That is an equilibrium. So Markowitz stopped at the individual optimization problem, and the capital asset pricing model now goes to one step further and tries to understand what that means for the overall market. Okay, that's the basic idea. So the capital asset pricing model is like a very, very, very influential model. It's an equilibrium model. It's like the foundation of modern asset pricing. And as you will see, to derive the capital asset pricing model, it's actually relatively simple. It's basically a model that is based on diversification. It's in the spirit of Markowitz. Basically, it's very similar to Markowitz. And there are a couple of people that are credited with this development, Harry Markowitz, because of the Markowitz portfolio selection model. But they mostly William Sharp and Lindner, John Lindner, so those who worked on these ideas that later formed the capital asset pricing model pretty much at the same time. There were two of the most famous essays in finance are William Sharp's essay, 1964, on capital asset prices, the theory of market equilibrium under conditions of risk. So this is really the birth kind of the capital asset pricing model. And John Lindner, at pretty much the same time, worked on the same ideas. So if you look now back at the development of the CAPM, people typically credit both of them. And there is another guy, Watson, and he also contributed significantly then, especially in later times, to the formalization of the model. Okay, so these are kind of the founding part of the capital asset pricing model. Good. So the capital asset pricing model starts at Markowitz. And because of that, it has actually a lot of the same assumptions that Markowitz also has. And I will go through them in a second. But I will directly start with the most important, the most crucial, the assumption of the capital asset pricing model that it newly introduces. And this is number one, this is 1C. Homogeneous expectations. This is crucial. This is the most critical assumption of the capital asset pricing model. And to understand that, let me very briefly think about with you what that means. The capital asset pricing model says that all people have the same expectations. So they have, here called identical inputs. So they have the same beliefs about covariances, about variances, about expected returns, and things like that. Okay? So basically what that means is when they draw mentally, remember when they draw mentally this picture in this being risk and this is expected return, yeah? So we said there are all these assets. Right? And this is all based on our estimation. So where exactly this point is based on what we think about its risk, for example. And then we can draw the efficient frontier, or the minimum variance frontier. And again, this will be based on our estimation of the covariance between all these assets. And then we derive, that's the risk-free asset, we can derive this optimal risky portfolio P. Right? That's what Marco would say. So, what happens now if all people have the same input list? Well, they will all end up with the same optimal portfolio P, right? I mean, P for, let's say, this is P for Thomas equals P for Mr. X equals P for Mr. Y. It's the same for everyone. Because remember, how we find the optimal portfolio P, that is also the total separation. How we find the optimal portfolio P is purely technical. Once we have the input list, we just do this optimization problem, and then we find P star. That's the optimal risky portfolio. That's all independent of our risk aversion and everything. Our risk aversion only determines where along in this, where on this capital allocation line we live. Okay? So because the capital asset pricing model introduces these homogeneous expectations, all people will now have the same optimal risky portfolio. Okay? And the capital asset pricing model will then call this the market portfolio. Why? Because it claims that all assets must be included in this optimal risky portfolio P, which is called the market portfolio. Why? Why was it not possible that we have a risky asset which is not included in P? What would happen to that asset? You have a stock, let's say, there's a new stock that is born right now, let's call it Startup Inc. And Startup Inc. would not be included in P star. What would be the demand for Startup Inc.?
It depends on whether it make it improve optimal.
Right, that's the question whether it's improved or not, whether it's included or not. But what happens if it would not be included?
No one will buy it.
No one will buy it. The only risky stuff we buy is P. If something is not part of P, we are not buying it. Right? So actually, the demand for any asset that is not part of the optimal risky portfolio P in the cap amber with these assumptions would be zero. And this cannot be an equilibrium, right? I mean, if the demand is zero and the supply is higher than zero, I mean, we're not in equilibrium. So the price will adjust until it is included. And you're right, I mean, whether it is included, we will come to that, depends on how it contributes to the risk of the portfolio, and how it contributes to the risk premium of the portfolio. Yeah? But the crucial thing is every asset in the whole universe, every risky asset has to be part of P. And that's why we call it the market portfolio. Because it's the overall market. But I will get back to that. Just for you to understand where we are going. And this is like really the pricing condition and everything that the CAPM will use to do all its calculations. This is the idea. Everyone has the same optimal risky portfolio P, which is then the market portfolio, because all assets have to be. And that's the CAPM in a nutshell. This will have consequences then, and we will derive these consequences. Good. So what about the other assumptions? The other assumptions, I mean, 1A and 1B is relatively simple. Rational mean variance optimizers that's similar to Markowitz, that basically gets taken from Markowitz. It's a single period model, but conceptually that's not very, it's not the core. We could extend that to multi-period model theoretically. And then we have some assumptions about the market structure. 2A is also somewhat critical. 2A is that all assets are publicly held and trade on public exchanges. Which is clearly wrong, right? Because many assets are not trading on public exchanges. What is not trading on a public exchange? What? Private equity, everything outside here, real estate, right? Bank loans, many things. There is even an asset that tends to be the most valuable asset, for especially younger people. That is clearly not traded. So what is your most valuable asset? Cash? Probably not, right? I mean, most students are not like super cash rich. Real estate? I guess most of you don't own an apartment. Gold? How many own gold? Probably not too many, right? Crude oil? No. What is your most valuable asset?
A computer, probably.
No, something that is much more valuable than your computer. Yes, your human capital. I mean, then what generates your cash flows in the future? 90% probably comes from your human capital. For most people. So, and this is another thing that is obviously not traded on a public exchange. Human capital is very much tied to yourself. So B, C, and D are really not that important. Investors can borrow and lend at the same risk-free rate, but that you can relax. You can take short positions, that you can also relax. No taxes, yeah, that's purely for simplicity and no transaction costs. That's really not the core of the model. So if you think about the validity of these assumptions, well, many of them are not 100% valid, of course, but for some it's not that important. No taxes, no transaction costs, for example. That's only there for simplicity. That's not so crucial. But especially the homogeneous expectation, I mean, that's the core, the most crucial assumption of the CAPM. But is it true? Do all people have the same expectations? No. And you can process the same information differently, the same news especially differently. But this is clearly wrong. And this is one of the big criticisms of the CAPM, that the most central assumption is wrong. Badly wrong, actually. We will talk in a few slides about the consequences of that and whether we can still somewhat trust the outcome. But in model terms, this is wrong. Right? And this assumption is just wrong. And I will show you in a second, the model collapses if we relax it. There's a nice anecdote that shows how wrong this assumption actually is, because there's a professor, a finance professor in Spain, and he always, like every year or every second year, he sends an email to all finance professors around the world, so a couple thousand. And then he asks a very simple question. He basically asks, what do you think is the market risk premium? So the expected return on the market minus the risk-free rate. And then you can respond. Many people do that, and then he publishes that in a paper and says, look, this is what people say. I mean, without names, of course. But the interesting thing is that there is a lot of variation in the answers of people. So this is only a subfield of investors. This is a very specific group. I mean, it's only finance professionals. So naturally, you would think we kind of have access to the same type of information and books, but still, even within that subgroup, the estimation of the market risk premium varies dramatically. So people clearly do not have the same expectation.
And you also assume that one asset can only have one price.
Yes.
But sometimes that means like cheap.
Say that again?
Like Russian oil, right?
Yeah, okay, but those are very special cases. No, I mean, we assume a standard market, there is the same good has like one price, so there's demand and supply for that good, and very standard, okay? Very simple. So the way how the CAPM is set up, at least at the beginning, is very simple. We can later make it more complicated, and I will show you one extension of the one to make it more complicated. But honestly, many of these assumptions here, we have them to make it more simple. Okay? Good. So this is what we already talked about. So this is Markowitz, capital allocation line, optimal risky portfolio P, and the complete portfolio depending on our risk position. Again, if we all follow Markowitz, and if we all have the same input list, we will all end up with the same optimal risky portfolio P. So the only thing that will differ among investors is the complete portfolio, so how much we invest in P and how much we invest in U. So in order to have equilibrium on the capital market, we must have all risky assets in portfolio, because demand is zero for all assets that are not what I just said. So this is why we call this the market portfolio. All investors will hold the same portfolio of risky assets, which we now call the market portfolio. The market portfolio contains all assets, and the proportion of these assets in the market portfolio is the value as a percentage of the total market value. So, if you think about it, if you illustrate it a bit more, this is Markowitz, this is Cabot. Basically the same thing, right? In Markowitz world, we call this the optimal portfolio P, we call this the capital allocation line. Now we move in the equilibrium world of the capital asset pricing model. So we add this homogeneous expectation assumption, and we say market must be in equilibrium. So now this becomes the market portfolio. It's the same thing. Yeah, it's the same thing. We just call it the market portfolio now. And the capital allocation line P, we are not calling this the capital allocation line M. This is pure terminology. We just call this the capital market line. Okay? Market portfolio, optimal risky portfolio, those are the same things. It's just if you look at it in the capital world, in the equilibrium world, homogeneous expectation, so it's market. Okay? Clear? So, question. What happens? What would happen if we give up homogeneous expectations?
That everyone will have a different optimal portfolio.
Right. Everyone will have a different optimal portfolio, risky portfolio. Right? Let's say black, this is me, and green is your portfolio optimization problem. You do Markowitz optimization, but you think I'm wrong. This shouldn't be here, this should be here. And this should be here, and this should be here. So I made a couple mistakes according to your opinion. So you correct those mistakes. You get a different minimum variance from here. You get a slightly different tangency line, and you get a different optimal risky portfolio. Right? So this is Mr. Z and this is Mr. P. And I can do this again and again, so blah blah, so we can have another investor, so this other investor will have, again, a different one. Because they have different inputs. The calculation of P is purely technical, but of course if you change the inputs, P will change. So what happens if we have 3 or 5 or a number of investor times number of investors, different optimal risky portfolios? And this whole idea falls apart. And there is no market portfolio anymore. We just have multiple optimal risky portfolios that are different for everyone, and we cannot claim that an asset has to be included in your or my or your optimal risky portfolio, because we just don't know. Probably it's not in my optimal risky portfolio, but we have another investor, and then it's the optimal risky portfolio of this other investor. So suddenly this whole idea falls apart. And the CAPM explodes. So as soon as you give up this assumption of homogeneous expectations, you do not have a market portfolio anymore. So we cannot argue that every asset has to be included in the market portfolio. Like I said, just boom, exploded. Okay? So for the theory model, this assumption of homogeneous expectations we cannot give it up. Not a single bit. Just destroys the model.
They're close enough to each other. Then there needs to be a
Yes, so people, and I will get back to that in a second, after the break, when we talk about the application and also the review kind of what we think about it. But you're right. The people say in practice it probably doesn't matter so much, as long as the optimal risky portfolios of people are highly correlated and highly diversified, and we can assume that they are kind of highly correlated with the market portfolio that we cannot observe anyway. The results of the CAPM should still approximately know. That's a very good comment. The thing is, that's true probably, but that's a practical, that's about can we use the model or not. It's more about the practice, the application. In the theory, the theory is gone. I mean, it all collapses. For the theory, you need exactly one optimal risky portfolio for everybody. You need exactly the same expectations, exactly the same input risks. Of course, we don't have that in practice. And that doesn't mean that the whole CAPM is crap. But again, the theory would completely fall apart. The theory needs this 100%. Okay? And why? Well, you can see it. I mean, if you have only two different optimal risky portfolios, there is no market portfolio anymore. Okay? So that's the idea of the capital asset pricing model. Everyone holds the optimal risky portfolio P, which is the same. So every asset has to be included. That's why we call it the market portfolio. If any asset will not be included, the demand will be included. And this is actually what we will basically use as a pricing condition in the capital asset pricing model. So after the break, we will do a bit of calculations and end up with these famous CAPM equations. Okay, but let's have the break first. 10 minutes break. Okay, so let us continue. So that's the basic setup, the basic motivation, idea behind the capital asset pricing. Okay? So now let's try to do a bit of calculations. So we start very simply, and then we become a bit more advanced, but it will all be very understandable. So what is the market risk premium in the theoretical CAPM model? The market risk premium will actually be proportional to the risk of the market portfolio and the degree of risk of it. Why? We can easily show that. We start with this well-known formula, that Y, which is the fraction we invest in the risky portfolio P, we take that one-to-one for market risk, equals the market risk premium scaled by the market risk, the risk of the market portfolio, times A. So in the simple CAPM economy, this is really a model very simplified. Everything happens within this economy. There is no outside borrowing, no outside lending. So any borrowing position must be offset by a lending position. Now imagine the whole world consists of us in this room. If I want to borrow, some of you have to lend money to. And exactly what you lend is what I borrow. So if I sum that up, it's always zero. The net position within that room will always be zero. Because what one person lends is what the other person borrows. So the net lending and borrowing in this economy will be zero. And that means that the average position in the risky portfolio is 100%. So on average, people hold the market portfolio, but some investors are a bit more in the market portfolio because they borrow money and then they overinvest, and other people are a bit less in the market portfolio because they lend money to others. Now, this is very simplified, very simplified. Okay, but I think the basic idea kind of understand it. The average position is 100%. So now we can easily see that, like, if the average position in the market portfolio is 1, we can set this equation to 1, and then we can simply solve for the market risk premium. So the market risk premium here is then nothing else than this on this side, so it's the average level of risk aversion times the market risk. Very simple. That is not yet what we find super exciting about the capital asset pricing model. What people find much more exciting about this model is actually that it will allow us to calculate the risk premiums for individual securities. So this will really be the strength of the model, that it allows us for an individual security, a stock, to calculate the expected return. And this is what makes the capital asset pricing model to some degree unique. So what determines the risk premium, or what determines the expected return on a single asset? So the risk premium on an asset, so how much you basically, this is the intuition, next slide we have to calculate. So how much risk premium do you charge? Let's say you are a CAPM investor, you hold the market portfolio. Okay? Now, suddenly there appears a new stock. Like in my previous example, let's call this startup. Yeah? The startup stock, you can add into your portfolio or not. What are you looking at? The first thing that you might be interested in is how much startup changes the risk for you. Right? So you add into your market portfolio, and then you want to know how much the risk changes. Which factor or which feature of the startup in stock determines how much your risk changes? The covariance, right? Not the firm-specific risk, right? Why? It's immediately diversified away, right? You have the market portfolio. That's the most diversified portfolio that ever existed in a sense. So you add something, startup stock, the firm-specific risk part, you don't care. It's immediately gone away. But what you care about is how much startup moves with the market portfolio, the overall market. If you add startup, and let's say startup moves a lot with the market, what happens is that the market is up, so your market portfolio gains. Now your new stock startup moves with the market, so it increases this gain even further, because it moves heavily with the market. Let's assume. What happens if the market crashes? Your market portfolio is already down. The new stock is also down. So the crash in your market portfolio will be even more pronounced. So if something moves a lot with the market, that increases your risk. What if something moves against the market? Let's say a startup moves against the market. You add it to your portfolio. Now suddenly your portfolio becomes less risky, right? Because the market goes down, but the new stock goes up. So it's kind of a counterforce. The market goes up, the new stock goes down. So if something moves against the market, it decreases your risk. But in any case, how much it affects your risk will depend on how much it moves with the market, the covariance. The covariance will determine how much the new asset startup affects the risk of your existing market portfolio. Idiosyncratic risk will play no role. Idiosyncratic risk can easily be diversified away and does not require any. Okay? Good. Is that clear? So intuitively, it should be the covariance that matters. How strongly something moves with the market.
But how would we know the variance when we go with like no prior knowledge about it?
That's a very practical question. In the theory model, we know everything.
Yeah.
Yeah. But it's a good one. Of course, in practice, that would be more difficult. But in the theory model, every asset is born with like a covariance and whatever. Okay, it's just an illustration. But it's a good one. Yes. So, and it's important to realize that this co-movement with the market, how much the stock co-moves, that's why it increases or decreases the risk. This is not something you can easily hedge, or this is not something you can diversify away. If the stock moves with the market, it moves with the market. I mean, we have no derivatives or stuff like that. This is not something that is diversified away. It's not like idiosyncratic risk. That's a risk factor that will stay here, that we hold in our portfolio. Okay? So now let's do some calculation. Okay, let's see whether we can show that the risk that matters is the covariance also in the more formal one. So this is the well-known formula. The variance of the portfolio equals this term here, the first part, the second part of the covariance part. Okay, that is well known. There is a quite illustrative way to show this variance of a portfolio. And this is called the bordered covariance matrix. What is the bordered covariance matrix? If you have a two-asset portfolio, it's a 2x2 matrix, and the elements of the matrix are the covariances of the assets. And here we have basically the assets and their weights. Why is this bordered covariance matrix nice? Well, because it gives us an easy way to see illustratively, easily, what the variance of the whole portfolio is. Because the variance is nothing else than the sum of all these elements, weighted by the columns and rows. So let's try this for the two-asset portfolio. Covariance R1 times W1 times W1. That's the first part. Covariance R2 or R1 R2 times W2 times W1. That's the second part. And then we have the third and the fourth part here. Okay? So now if we look at this, and if we add this up, and if we keep in mind that the covariance is nothing else than the standard deviations times the correlation, we can see that this equation, this line, equals exactly this equation. Because W1 is obviously W squared, covariance R1 with R1 is the variance of R1, right? And this is the same for R2. And here we have W1, W2, W2, W1, so that's where we get the 2 from, and covariance R1, R2 is the same as the covariance R2, R1. It's exactly the same. And obviously for the two-asset portfolio, we can simply memorize this formula. But if we have a 10-asset portfolio, I mean, that would also work. The border covariance matrix actually always works. I mean, obviously, if you have 10 assets, there are a lot of elements to write, but it's very intuitive.
Covariance of R1, R2, 1.
Now, the covariance is the standard deviation times the correlation.
One, covariance of R1 and R1.
The covariance of R1 with R1.
Yeah.
No, it's just the variance of R1. Because the covariance is the correlation times the two standard deviations. That's how the covariance is defined. This is not the correlation, this is the covariance. Yeah. It's the correlation equals 1 times the standard deviation of 1 times the standard deviation of 1, which is the variance. Okay? Clear? So this is now, I mean, this is not specific to the end, this is just generally true. Now let's try to understand why we need that, why that could be helpful. But now let's try to think a bit more formally how a new stock, how a single stock contributes to the risk of the market portfolio. And let's say we have a stock and here is GE. What is GE's contribution to the risk of the market portfolio? And that's our question. So let's try to understand what the variance of the market portfolio is, and for this we draw this order covariance line. Same as before, and elements, easy. So, and one column here will be the column that is related to G. Okay? And actually the contribution of GE, the variance of the market portfolio, is nothing else than all the elements weighted in this column. So if you would remove GE, what would happen is basically this column would go away, and this would be the new, then adjusted variance of the market portfolio. So this column, again, we have to do what we would call the covariance matrix, so we have this element times the weights, here, WGE, W1 times the covariance, for all the elements, and then we get the sum here. This is the contribution of the single stock GE to the variance of the market portfolio. Okay? Just the one column of the bolded covariance matrix. That's GE's contribution. And as I will show you on the next slide, this sum here actually simplifies to the covariance of RGE with the market. I will show you that on the next slide, why this is the case. And then we have the WGE. So what the message now is, and this is exactly what you suggest, what you intuitively thought before. The contribution of GE to the market portfolio is the weight of GE in the market portfolio times the covariance of GE with the market. No firm specific risk now. Okay? Is that clear? So why is this sum? Why is this here? This bracket, this red bracket term. Why is this the covariance of RGE with the market? Well, it's just mathematical restatement. When you see it must be true. So the covariance of RGE with the market, let's start from the end. So what is the covariance of RGE with the market? Well, the returns of the market is nothing else than the weighted average of all the returns in the market portfolio.
Do we include GE in the market now, or we include it later?
No, that would be included later. I mean, that was not
included before ending.
Yeah, kind of. So, it's basically the sum of all the elements in the market portfolio. So here, weighted average of all the elements of stocks, risky assets in the market times their weight. And then we can just restate it. I mean, the covariance of RGE with that sum, I mean, the sum we can put it in front of the covariance. And the WK, the weight, we can also put it in front of the covariance. That's mathematically equivalent. Okay? And then what we see is that the covariance of RGE with the market is the sum of the covariance of all the elements with RGE, weighted by the elements. And this is exactly what we have here, the covariance of RGE with all the other assets weighted. Okay? Clear, kind of? But, I mean, probably I got your question wrong. You mean, in the market portfolio, do we assume that RGE right now is in the market portfolio? Yes, we do. I mean, that's why we have the covariance of RGE with RGE also.
If the LM includes RGE.
Yes. It's the current market portfolio, and we want to see the contribution of the one single stock. So my
LM here will be free, including GE.
Yes. My illustration of like you have a new stock and that's kind of illustration. But now Now, what we technically do is we look at the market portfolio that consists of 100 stocks, and GE is one of those 100 stocks. And then we want to know how this GE stock contributes to the market portfolio. Yeah, but it is already part of the market portfolio. Because in the model, when the stock is born, kind of, it's not a dynamic model, it's a one-period model, right? So that doesn't happen in the model. But every stock always is part of the market portfolio because we have an equilibrium model. You could not ever have a stock that is not part of the market portfolio. So what I said, the stock is born, this is kind of a sloppy, intuitive way to explain things. Technically, we have the market portfolio that consists of n stocks, and we want to know what is the contribution of a single stock to this market in terms of risk. Okay? Clear, kind of? Other questions? Ask again.
I'm a little puzzled about the model, like WG comparing G and R. So clearly, R doesn't include G.
It includes G. RM is like,
okay, so
it's the overall market portfolio, and G is included in the market portfolio. Okay? Good. So, what we found now is that the contribution of GE to the risk, to the variance of the market portfolio, is exactly this expression, WGE times the covariance. Okay? So, when we trade off, when we think about whether a stock is included or not in the market portfolio, when we trade off risk against benefit, risk premium, so what is the risk premium or GE's contribution to the risk premium of the market portfolio? And that's pretty simple. It's just the risk premium of GE times the weight of GE in the market portfolio. That's just like linear, like always. Okay, so that's the kind of upside of GE, and this here is the downside of GE. The risk contribution and the risk premium. Okay? So then we can basically just do a few calculations, very simple ones. What is the reward to risk ratio for GE? So we take the risk contribution to the risk premium, we take the contribution to the risk, and we set that in relation, and then we have this is the risk premium of GE divided by the variance of RTE. We can do the same thing for the market portfolio as a whole. So what is the reward to risk ratio for the market portfolio as a whole? Well, this is nothing else than the risk premium on the market portfolio, with the expected return on the market minus RF, scaled by the risk of the market portfolio. Pretty simple, pretty straightforward. And now, this is now what I said at the beginning. In an equilibrium model, we can use this as a pricing condition. We can actually use the fact that every risky asset has to be part of the market portfolio as a pricing condition. Okay? What that means is that in equilibrium, the reward to risk ratio for the market portfolio must equal the reward to risk ratio for every stock, including GE. Why? What would happen if the risk premium, if the reward to risk ratio for GE would be lower than the reward to risk ratio for the market portfolio? But then you wouldn't have equilibrium, right? Because then this would be less attractive than the market portfolio. People would basically throw it out of the market portfolio. They would say, oh, I don't want to invest in GE. There would be no demand for GE. Or my somewhat a bit sloppy but still illustrative example, if Startup Inc. is born, and the reward to risk ratio of Startup Inc. is lower than the reward to risk ratio for the market portfolio, so the price cannot be equilibrium, right? The price will adjust. However, at the same hand,
what if they underprice it? So a bunch of people buy it underpriced. Will it change the portfolio? Because some people buy cheaper and then it's like.
This is a one-period model, one-shot game. I mean, basically, you're not in equilibrium as long as the price changes. The price would adjust immediately. Basically, in the cap and the price would not adjust. Yes, it would be born with the right price. Okay, this is just illustration. I mean, I say, oh, price would adjust. In the CAPM, it's a one-period model. Things are born in a way that this equals this, otherwise it would not be an equilibrium model. Okay? So, what would happen if the reward to risk ratio for GE would be higher than the reward to risk ratio for the market portfolio? Obviously, also not an equilibrium, right? Because then people would only buy GE and they would go out of the market portfolio. So there would be no demand for all risky assets except GE. But if the reward to risk ratio for GE is higher, they can basically create a second capital allocation line that has a higher slope, a higher Sharpe ratio than the capital market line, and they would only invest along the capital allocation line GE. So the only way how we can have equilibrium is when the reward to risk ratio equals of GE equals the reward to risk ratio for the market portfolio. And this is exactly what we do. And this is then one step away from the end of the capital asset pricing model. We set those two equal, the reward to risk ratio for GE and the reward to risk ratio for the market portfolio. And then we're basically done. Now we can solve for the risk premium of GE. So the CAPM now tells us the risk premium of GE is nothing else than the risk premium of the market times the screen term. And the screen term is the covariance of RGE with the market scaled by the variance of the market. This green term measures systematic risk. It measures how much the asset moves with the market. And this green term is called the beta coefficient. So beta doesn't show up in the CAPM when you develop the CAPM. Beta is just used as kind of a placeholder for this green term. People then just simply call this the beta. This is how beta is defined. Okay? So then we can restate it further, so we can have the expected return, we just bring our f to the other side, equals the risk-free rate, plus market risk premium times beta. This is the famous capital asset pricing model equation. It was so-called security market line. Okay? So probably you remember when we talk about the index model, I showed you this video where this guy tried to calculate the beta for Amazon. I think he downloaded the data from Yahoo Finance, and then he said there were two ways to calculate beta. And when he talked about the first way, I told you, well, we haven't done that yet. And the second way was the slope function, right? I mean, that is what we treated when we talked about the index model. The first way is exactly this. He divided the covariance of the returns of Amazon with the return of the S&P 500 to the variance of the return of the S&P 500. That's the first way. That's the simplest way to calculate beta. Just use the definition maybe. So, what is the core message here? The expected return on any security does not depend on idiosyncratic risk, it only depends on systematic risk. The only firm-specific component on the right-hand side of this equation here is beta G. This is not firm-specific, this is not firm-specific. And the only firm-specific part here, because this is also not firm-specific, is the covariance of RT with the market. So if something moves a lot with the market, high expected return. If something moves only a little bit with the market, low expected return. Okay? Clear? So, for the beta, this is a quick slide. Just a quick remark. Beta is nice because if you have a portfolio, and you know the betas of all the assets in the portfolio, then the beta of the portfolio is just the way there. That's very simple. And the return beta relationship holds for all portfolios, it holds for individual assets, it basically holds for everything. Okay? So it even holds, but this is a bit of a, let's say, it's a bit of a silly equation. It also holds for the market portfolio. So if you do the expected return on the market portfolio equals RF plus beta of the market, which is obviously 1, times the market risk premium, what you get is expected return of the market, this drops out, this is 1, this equals expected. Okay? So this is the illustration of the core result of the capital asset. This is the so-called security market line. Okay, security market line. What we have here is theta. What we have here is expected return. Here we have the risk-free rate, and this is basically a plot of the equation that we've seen. The slope of this is the expected return minus the risk-free rate, because this is exactly one. Basically, the slope is the market risk-free and the market. Okay? So what you can clearly see now is if you have a so-called defensive stock, a stock that does not move a lot with the market, the expected return is low. If you have a very cyclical stock, a stock that moves a lot with the market, the expected return. So what would be an example for a defensive stock? Which stocks have low beta? Low beta stocks, what does not move a lot with the market? Things like bonds, yeah, they will move a lot, yes. But even if you think about different types of stocks, if we only think about equity, so we have some stocks that don't move a lot with the market, defensive stocks. What could be a defensive stock? Yeah, banking is a bit critical. Yeah, banking depends a lot on the time period. It's not a very good example. Yeah. Coca-Cola. Yes, beverages, for example. Something that you need on a daily basis, right? I mean, if you think about it, even during COVID, when the Hong Kong economy did very poorly, I mean, people still eat and people still drink and things like that. Food companies, beverage companies, things like pharmaceutical companies. I mean, all of them are also affected by GDP growth and by the overall market development, but not so much. And cyclical stocks would be things like car manufacturers. Prime example, because if the economy is doing poorly, I mean, people just stop buying cars. If the economy is doing great, people buy a lot of cars. So that's why car manufacturers often move a lot with the market. Market goes up, car manufacturers goes up, market goes down, car manufacturers. Or other, like commonly used examples would also be luxury goods. Things like that. I mean, just like for illustration. Good. Clear? Security market line. Expected return, beta. And beta proxy for systematic risk. Question. Assume gold has a beta of minus 0.1. What is the expected return?
A little bit lower than this.
Right.
But not that they
That's the question, right? So you can extend that here, beta can be negative, right? Remember beta, beta is the covariance, if the correlation is negative, this can easily be negative. So here, the goal would be below the risk-free rate. So now the question is, why would I buy something that gives me a lower expected return as the risk-free rate? Is that question?
some insider knowledge.
No, we have no insider knowledge. No, equilibrium. Fully efficient. Why? Why would you, but yes, very good to hedge, right? Think about what happens in a crash. If you have the risk-free asset, the risk-free asset is just stable, right? It always gives you 3% or whatever. But if you have gold, gold has a negative beta, so if the market crashes, gold actually goes up. So it acts like an insurance for your portfolio. It protects your portfolio. And it protects your portfolio much better than just having the risk-free asset because it moves against the market. Of course, the same is true if the market moves up, then actually gold moves down, right? But this insurance effect, and because gold offers you this insurance to your portfolio, That's why people are willing in the Japan to accept a lower expected return for gold as the risk-free rate because of its insurance. Okay. Yeah. So, and if we look at the data, it's actually interesting to see.
Isn't the more you hedge, then the lower the expected return?
Sure.
Then,
but many people hedge a little bit, right? I mean, what you see a lot is that, like, if
wouldn't it be better to move more portions into risk-free assets?
No, because gold can offer more effective hedge. Adding gold to your portfolio has counter-cyclical move. Adding more risk-free assets is just like flat. That's the difference. Of course, if you only hold gold in your portfolio, like in the extreme case, your expected return would be lower than the risk-free rate. And this is what we see in the data. So this is 200 years of asset prices. Okay? This is 1800 and this is, I don't know, maybe today, close to today. And then we have different asset classes, stocks, bonds, bills, gold, and ignore dollar a little bit. Currency does that. Okay? And here we have log scale. $1, $10, 100,000. So be careful, it's a log scale. This is all inflation adjusted. Now we look at $1 in 1800. Did it grow? How much did it grow over this 200-year period? And as the reference point, we take treasury bills, which is more or less the risk-free asset, so it's like 260. Okay? If we add a little bit more systematic risk, and as you previously said, bonds are still relatively defensive, they have a relatively low beta. If we add a little bit more systematic risk, we get a higher realized return, which is perfectly in line with the idea of the high expected return, on average higher realized. If we add stocks, I mean, the difference is crazy, because like stocks now we have a beta of 1 on average. I mean, at least depends on how you measure it. But you have a higher beta, let's put it like this. So $1 grew to $1 million. Okay? But the really interesting thing is gold. I mean, gold was super bad investment over the last 200 years. If you invest $1 in gold, I mean, it only grew to $3.
But wouldn't it be incorrect because the dollar is tied to gold prior to?
Yeah, this is a little bit mistake. So, but and I also said ignore the dollar. The dollar is, currencies are pretty special. The thing is, no matter how you look at it, gold performed very poorly. This is also true if you look at time periods after Bretton Woods was abolished and after there was no gold standard. Gold on average has a relatively poor return.
What about other commodities like nickel or coal?
Not so much, mostly gold, because gold has this feature, this insurance feature, this safe haven feature, that whenever people get scared, they run into gold. Physical gold and also gold ETFs.
And then would that be kind of hypothetical psychologically? That we just have a bit of belief that it all goes so it occurs.
I don't know. I mean, if gold has a negative beta, it actually makes sense. If you think the world is crashing tomorrow and I know gold has a negative beta, I put all my money in gold. Because then the world's crashing and gold's going up.
If everyone thinks there's a negative beta, then everyone would do that.
But that's fine, as long as, yeah. But if the beta is negative, of course, it can act as an influence. So it can actually protect your portfolio. And it seems that over this long time period, people are willing to give up return for having this insurance. And I mean, of course, we should take that with a pinch of salt. I mean, that's like, there's a lot of assumptions you have to make if you've got stocks for 200 years and stuff like that. Yeah, so don't look at the exact numbers, they are surely wrong. Yeah? Just look at the general pattern, and this is not only in this picture, this is what we generally see. Gold underperforms risk-free rates. Gold's really poor average. But gold performs relatively well in prices.
In recent years, many people said that when the stock market some perform well and they will invest in crypto. And does it mean that cryptocurrency also have a negative?
That's a good question, and I don't know, but it would be interesting if crypto has a negative
Since
feature.
currently they are highly correlated with stocks.
Yeah.
Nasdaq, so because people think that like cryptocurrency is necessary to stock.
And there's a with this action because the foreign store so it's not necessarily crypto is.
We just can't USDC as kind of like crypto. We're thinking.
And it doesn't matter. I mean, however you look at it, I don't know what the beta is. I mean, but it would be interesting. I would at least guess that in some times crypto can be countercyclical. Right? I mean, if the market goes down, people would say, "Oh, we need alternatives, so we go into crypto." I mean, that happens for sure. But the problem is with crypto, I think there are so many things that affect its price, especially regulation. And we still have a relatively short time series. And all those things are still a bit under debate. But probably it could be an asset that is also in the future used as safe haven asset once it is more stable, less volatile, something like that. Now I think crypto is still highly volatile, highly speculative. It's very different to gold. I mean, people go into gold because they want the safety of gold. Okay? Good?
With the tokenization of certain stocks like Tesla or more stocks with another because basically
I think that's an interesting question, but that's not super related to this. Yeah, probably we can discuss this later, just to keep things a bit in shape. So the security market line that we just saw, so this thing here, the security market line, can basically act as a benchmark for investment evaluation. So of course, in the equilibrium model and the capital asset pricing model, every asset will always be on the security market line. By definition, it's an equilibrium model, so everything is always on the security market line. Everything is correctly priced. But of course, in reality, you could say, well, look, what happens if I find a mispriced asset? So, for example, you could say there is a beta of an asset, and then you can use the security market line to calculate the expected return according to the CAPM. But it could be that you think that this is not a true expected return because you are an expert for this firm, you're an insider. For example, you have insider knowledge, but then you wouldn't be allowed to trade on it. Yeah? But it could be that you think this is higher or lower than what the CAPM says, in fact. So what happens if an asset is not on the security market? But if it's below the security market line, then we have a lower than required rate of return. And this is basically an overpriced asset. With negative value. What happens if it's above the security market line? We have a too high return. It's an underpriced asset, and we have a problem. So this is an illustration. We can basically use that to understand better what alpha. We talked about alpha before, actually captures and uses. Yeah? So assume you have a stock with a beta of 1.2, risk-free rate 6%, market expected return 14. We can use the security market line equation. So we get 6% plus beta times market risk premium equals 50 cents. Now, for whatever reason, you have to believe that the actual expected return should be 17%. So it's not this, it's this. Then this would be a stock, if you are right. It has an alpha of 1.4%. Because given the level of systematic risk of this stock, you only require 15.6% risk compensation. Right? If you actually get 17%, you get 1.4% overcompensation that is not justified. And this is what alpha is. So this now gives us a more structured, a more clear picture, a more clear view on what alpha is. Every stock has an expected return according to its systematic risk. But if the stock actually, in practice, has a higher or lower expected return than that, this stock can be positive. Okay? Clear?
So it's basically when this occurs, then the investors put a higher weighting into the stock without,
Yes.
or would they put all of it?
That's a good question. What do you think?
I think some, because they still want to diversify.
Right. Putting all in it would be pretty stupid, right? Because if you put all in it, everything here is wrong again, because then you are not diversified. And if you put all in this stock, you are not only exposed to systematic risk, but then you're also exposed to its idiosyncratic. Right? And then even the 17% might not be enough to compensate you for these two types of risk. When we calculate the alpha here, we assume that you are not exposed to the idiosyncratic risk.
Are we also assuming that our purchase will not affect the market?
Yes, but that's a relatively mild assumption. But to answer your question, this is actually something that I moved into Unit 6, and we will talk about that relatively at the end, optimal portfolio construction. But your hunch is completely right. If you find a positive alpha stock, you want to overweight it, but you still want to keep diversification. And actually, how much you will invest in the stock will depend on how high the alpha is. But the second component, what will also determine it, is how much idiosyncratic risk is stock. Right? If it has no idiosyncratic risk, zero, basically you could only go into that stock. But if it has idiosyncratic risk a lot, you don't want to overweight it too much, because then you move away from optimal diversification.
And how do we underweight the other kind of stock? Do we just do it all by the same ratio, or do we kind of
So basically, if you have a fully diversified market portfolio, the weight of every asset is the market value of the asset scaled by the market value of the whole portfolio, right? So, and then you could say, look, well, I want to overweight this to 5%, so then the 95%, then you distribute across all the other assets. You just adjust the relative shares. So you keep the relative shares constant. Okay, but I will show you the equations and how exactly that works later. Other questions? Good. So this is the cabin, more or less. Actually, this is the cabin. The basic idea: everyone's same portfolio becomes the market portfolio. Then we can relatively easily develop the security market line equation using this idea that an asset contributes to the risk of the market portfolio. Depends how much it contributes, depends on the covariance. And then we can do these calculations and we find the security market. Okay? So some practitioner views or some first thoughts on how meaningful all of that is. And I want to start by saying that it's the problem is not so much, or in practice the question is not so much, it's the small y. Because the answer is simple. No. It's wrong. It's a flawed model. It is oversimplifying the world dramatically. Homogeneous expectation, all assets are traded. I mean, this is all wrong. The problem is somewhat, we have no better alternative. Right? It's still probably the best model we have if we want to calculate effective returns for individual assets. So we know it's flawed, we know it's wrong. So the question is more, can we still use it? For example, what if not everyone holds the market portfolio in reality? And this is what you said at the beginning. I mean, probably in the model that's a disaster, the model breaks down. But probably in reality, I mean, as long as those portfolios that people hold, as long as they are highly diversified, somewhat highly correlated to true unobservable market portfolio, the result should still approximately work. I mean, this is not, I would like to say, look, there is a clean solution to that, but there isn't. I mean, this is something we have to assume. We don't know. Yeah? Most assumptions, and that's more the good news, most assumptions can be relaxed. Like taxes, we can introduce transaction costs, we can introduce different lending and borrowing rates. All of that is not crucial for the model. We can even take away the fully risk-free asset and say, look, nothing's risk-free in reality. We can take that away, and the model still survives. This is the only extension I will show you today, the so-called zero beta cap. So, yeah, it's not perfect, but it somehow works. And I will show you after the break. It's heavily used. So there is one aspect about the CAPM that I always like to mention because this sometimes creates confusion. People ask if the CAPM implies that well and poorly managed firms have the same return. Or you can also say that firms that have good technology and bad technology, or firms that have good CEOs and bad CEOs, firms that, I don't know, good products or bad products, do they have the same return according to the CAPM? And the answer is yes. The expected return is the same. Why? Because the fact that Apple has some nice technology, this is already priced today. This is not a new information, right? I mean, this is the reason why Apple was the first company to go above 1 trillion and to go above 2 trillion, because people think it has good technology. So if you buy Apple today because you think they have good technology, you are a little bit late. That would have been an appropriate strategy probably in the 90s or early 2000s, but not necessarily today, right? So the CAPM is a model that tells us something about expected future returns. So many things are already priced, not included in today's price. And the second thing that is often confusing is that obviously the CAPM is an asset pricing model, so it prices stocks, bonds, financial assets. It is not a model that has anything to say about accounting reasons. It's completely silent about it. It doesn't care, right? Of course, if you have good technology, I mean, Apple makes a lot of money. They have a high net income. Yeah, good. But that's not what the capital asset pricing model is about. The capital asset pricing model is about the expected return on the Apple stock. Okay? So it's a model for expected stock returns. It's not a model for accounting. I think that's clear. But because sometimes this creates confusion, I always like to make this point very clear. Okay? All right, time for the second break, 10 minutes break, and then we continue.
I'm wondering, wouldn't it be the case if
Good. So, last part for today. Okay. So is the CAPM practical? Yeah. As I said, I mean, this is pretty much what we discussed before. It's a theory model, it's a simplification, it's far from being perfect. It's still probably the best one we have to explain returns of risky assets, especially individual risky assets. One of the problems is that we have to do the proxy for the market portfolio because the true market portfolio, the portfolio that contains all the assets, that is of course unobservable. So we cannot use that. But yeah, it is widely used in practice. It is quite accepted actually. So these are some applications of the capital asset pricing model. Whenever we need to calculate expected return or required rate of return for risky assets, the CAPM is commonly used. So this can be in the context of firm valuation. So if you remember, we talked about dividend discount model, where we use the CAPM, get the discount factor. We talked about discounted cash flow models, where we need the WACC, the weighted average cost of capital, and there the equity part also comes from the capital. Okay? It can also be used for things like capital budgeting. So cost of equity is often, it's then also needed. Capital budgeting applications could, for example, be that within a firm you plan a new project, and you want to know if this project is profitable and should be undertaken or not. Think, for example, about Tesla. Tesla could think about inventing a new electric motorcycle. Then they could run basically DCF models, predict the sales from the motorcycle, predict the cost. But again, of course, they need a discount factor. And what they then often do is they simply use the term Fina and calculate the cost of equity. But of course, if you do that, I mean, the devil's kind of in the details. So if you have a company that has different divisions, I mean, then people argue that you should adjust the risk of the division. Like Siemens, for example, the German company, they have many different divisions, medical products, but also power plants, and they are vastly different. One might have a much higher beta than that. So it's a bit complicated in practice, but it's still, CAPM is still widely used for these applications. The CAPM is also used, or the ideas of the CAPM for investment valuation, because if we have a fund, a mutual fund, and we know the beta of the fund, we know what return the fund should deliver to justify the level of the level, right? Then we can see whether the fund manager does it or not, and we can then use this as kind of a benchmark. And lastly, the CAPM is and was used in legal settings. So when you have to determine risk-appropriate compensations, then the CAPM is often used to determine risk, expected returns. So let me show you, I found this press report about a court case. But I think it's quite interesting to see how much the CAPM is appreciated in practice despite all its shortcomings. So there was a Delaware court case where basically the minority shareholders of a company claim that their shares were undervalued. So what happened was that the company basically merged with another company, or was, I don't know much about the case, honestly. The company was taken over by another company, and then the minority shareholders were basically squeezed out. So the overtaking company was saying, look, we did some valuation model, and according to the valuation model, the value of your shares is, I don't know, $1.53, and then they offer them a little bit of a premium on top of that. So basically, they pay them $2 per share. And then the shareholders were unhappy because they said, your valuation model is wrong, and they went to court and said, look, these guys, they stole money from us because actually our shares have a value of $5. And that's all not super important. The most important thing is what this report says. So one of the things is the most hotly contested issues where the appropriate discount rate be used in the DC. Which really shows, I mean, this is a complex issue. It's not easy to come up with the right discount rate. It's tough. And then another statement that I find interesting. The court ultimately ruled that the CAPM is the accepted model for valuing corporations. While the BUM, the so-called build-up model, is not accepted by mainstream corporate finance. So the build-up model shouldn't be called a model probably, but the idea of the build-up model is simply you have a risk-free rate and then you add components. But how you add these components, how many, how exactly you measure that, there's a lot of discretion that different people apply when they use this model. Okay? So one thing about the CAPM that is really nice, if you compare it to something like the build-up model, the CAPM kind of restricts us to a theoretical idea, right? It says measure beta, that's the covariance of the stock with the market, scaled by the market's variance, that's beta. Then you can argue, do you use S&P 500 or 1500? But it's like the result will be somewhat similar, right? Or you can argue the time series, but again, the results will be somewhat similar for most corporations. And then you multiply that by the equity risk premium, by the market risk premium, and add the risk-free rate, and that's it. So it's much easier to justify a model like that if you are in court, compared to a build-up model where you say, oh, the risk-free rate, and yeah, this company is kind of risky, that's why I added 5%. So I added 7%, so I added 3%. I mean, there is no guideline. So that's, after talking about many bad things of the CAPM, we really have to appreciate that the model gives us a coherent framework. And lets us calculate properly. And this is not highly appreciated by practice, and this is where this statement is coming from. Good. Now, knowing that the CAPM, one of the key assumptions of the CAPM, homogeneous expectations, does not really hold in reality, what we would like to do is we would like to test the CAPM. Right? We would like to develop a test, and then we simply check whether the CAPM is true or not. The problem is that this is also not easy. The CAPM, test the CAPM, you can basically think about two strategies. The first is you can test the market portfolio. Basically, if people invest in the market portfolio, if this portfolio is efficient, and in an extreme case, you could check if all people hold the market portfolio. Okay? Or you test the security market line. You test whether actually expected returns or returns really go up in feedback in a linear fashion. It would be better to test one, because that's really more at the core of the model. That if we could find that would be really helpful. The second test has been heavily criticized. I will come to the critique of the second test in a slide. So we would like to test the market portfolio. The problem with the market portfolio really is that this is a theoretical idea. It's inherently unobservable. We cannot observe it. It includes all risky assets that can be held by the investors. It's the whole market. It's not just an equity index. It includes real estate, private firms, bonds, everything. Right? So how would you observe something like that? It's impossible. There are no market prices. Honestly, even if you move from stocks to bonds, even bonds are hard to observe, because except for the most liquid bonds are terribly illiquid. Sometimes you have no trade for a week or two and you have no price movement, but you don't know if the price still reflects value or probably not, and there is no trade, there is no updated price. So long story short, we would like to observe the market portfolio, because that would help us to test the capital asset pricing model. But we can't. It's just not possible. So, empirical tests of the CAPM basically exclusively focus on truth. And I show you one example. There are hundreds out there, all with strengths and weaknesses. So there's a paper by Eugene Farmer and Kenneth Branch from 2004, and I have uploaded this paper on Moodle for you, and I call this further reading. Okay? Further reading means that this will not be tested. Yeah, and not test details of this paper in the final exam or something. It's really for your own interest. And they describe a bit how the CAPM can be tested, a bit the challenges, and actually this picture is taken from their paper. So if you have an interest in tests of the CAPM, I recommend you to take a look. So what do we see here? So this is from Palmer and Branch. This is beta. As basically they group all stocks into different bins according to their beta. And here what they plot is the average annualized monthly return over a long time period, 28 to 03. But this is of course not expected return, because expected return is unobservable. That's why we need the CAPM. If we could observe the expected return, we wouldn't need the CAPM in the first place. So we have to use historical and realized returns as proxies for expected returns, which is already not great. That's why we need to use a long time series so that we can argue over long time series. The realized return should be approximately equal to the expected return. So what do they find? Well, the black squares here, those are the average annualized monthly returns for stock in a specific bracket. Here, or here, or here. Okay? So you see that, like, if you move to higher betas, actually the realized returns are somewhat higher. Okay? That's based on the data. The black line here, this is the beta return relationship as predicted by the CAPM. Much steeper. So what they basically find is that, yeah, there is a positive and probably even linear risk return relationship, or beta return relationship, but it is likely not as pronounced, not as strong, not as steep as predicted by the method asset pricing. Okay? So different tests find slightly different results, but generally they support this positive relationship, this linear relationship. There is more debate on how strong and how steep all of that is. But it seems that the basic message of the capital asset pricing model is more or less found in the data. So take a look, if you're interested, take a look at the paper. It describes things very well. It's very easily written. So people were kind of happy. They said, oh yeah, okay, we find a positive relationship, so the CAPM owns, great. But then came Roll, and Roll said, look, wait a second, this is all nonsense. Testing the security market line doesn't work. It doesn't prove that the CAPM is true. The only way to prove the CAPM is true is to test the market portfolio, which is not possible. Because what Roll said, and of course he also showed that in his paper, is that the only thing that the security market line, this positive relationship, shows is that the proxy that people use as the proxy for the market index, that this proxy was exposed risk return efficient. You can also say that this proxy was very well leveraged. So he basically says that any proxy you use for the market portfolio, you find this thing. So for every risk-efficient portfolio, the returns depend in a linear fashion on the beta measured relative to this risk-efficient portfolio. So the details are a bit tricky in that we don't have to be so concerned about the details, but he said his basic statement is any test that looks at the security market line is by definition wrong. So that's more or less equivalent to saying the capital asset pricing model cannot be tested. Because if we cannot test through the security market line, and we cannot observe the market portfolio, there's nothing else we can do. People kind of criticized also Roll and they said, oh look, we also make some assumptions that might be wrong. So more or less there's a debate going on since 50, 60 years. Bottom line is really, it's very heavily used in practice. There is still nothing better in the sense that it's, given its simplicity, its theoretical appeal, it's very easy model, it's easy to explain, easy to understand. Yeah? Okay? But if you can come up with an asset pricing model that is equally easy, but more correct, people would be very interested, I'm sure. Questions? Yeah.
But won't the model will depend on whether people believe in the model? Because if everyone believes in the model, then they will.
Yeah, that's a fair point. Right. If everyone believes in the model, if everyone acts according to the model, you could create this relationship also somewhat mechanically. That's a fair point. Yes. That's also a reason why probably testing the security market line is not a meaningful strategy. It doesn't really test whether the CAPM will receive it. extensions of the capital asset pricing model. There are numerous extensions, and I only want to show you one, just to show you a bit of flavor of the idea behind this extension. So the basic idea is really take away one assumption, and then you adjust the model and try to make it survive without this assumption. And what we do here is we take away the assumption that there is a risk-free asset. So basically we assume now there is no risk-free asset. Okay? The idea is that we can find a so-called zero beta portfolio. And this zero beta portfolio, as its name suggests, has a very nice feature. It has a zero beta. It is completely uncorrelated with the market portfolio. The fact that it has a zero beta means that it has zero systematic risk. Right? It's completely uncorrelated with the market portfolio. And this means that CAPM investors can use this as a replacement for the risk-free rate. Because the only risk a CAPM investor cares about is systematic risk. As long as set as the zero beta portfolio, as long as this has no systematic risk, it's a perfect replacement for the risk-free asset. The zero beta portfolio will have firm-specific risk, of course. But the CAPM investor doesn't care about it. It's immediately diversified away. So that's the basic idea. And then Merton and Rowe showed actually that the zero beta portfolio must always exist, because for any portfolio on the efficient frontier, there is a so-called companion portfolio on the inefficient part of the frontier, the invariant frontier. And those two portfolios, those companion portfolios, they are uncorrelated. That's the illustration. So this is the efficient frontier. This is the inefficient frontier. Yeah? So every portfolio on the efficient side has a companion portfolio somewhere here, and the correlation between both is zero. So that must also hold for M, the market portfolio. So there is a zero beta portfolio that we call Z. They are completely uncorrelated, so that means this must have a beta of zero. Okay? Z, the zero beta portfolio, obviously has a positive level of risk. Right? But all this risk, 100% of this risk is firm specific. None of this risk, nothing, is systematic. Systematic risk is there. Because of that, it is a replacement for the truly risk-free asset. You can take the expected return of Z as a replacement for the truly risk-free. Okay? So this is a very quick walk through the idea of the zero beta portfolio. Of course, it's a bit more complicated than that in some dimensions, but that's the general idea. Find the so-called companion portfolio of the market portfolio. Correlation zero. So this portfolio has beta of zero, no systematic risk. And that means we can use it as a replacement for the truly risk-free asset. Okay?
But how can it be no correlation when they both have the same composition, kind of, the market?
But they can have different weights in the same stocks. It's just a different portfolio.
But isn't weighting it?
So the portfolio
has some kind of correlation.
Portfolio Z does not necessarily include all the stocks in the portfolio M, right? The market portfolio includes all stocks, but Z can be just a subset. Z does not necessarily include all the stocks. Like in the extreme case, think about Z as one single asset. That's just a stock that's coincidentally on the efficient frontier, the minimum variance frontier. And this stock is zero beta.
Wouldn't it be included in the market portfolio?
That's fine. But here it only has a tiny bit of weight.
So it will be close to zero.
No, it will be zero.
But when they have a tiny weight, then it's
Yeah, because in reality, of course, it's not a single asset, right? It's a portfolio. And also they might share some assets, yeah? Their correlation will still be exactly zero. That's mathematically not so easy to show. That's actually what Burton wrote. They wrote a paper showing that mathematically there must be this companion portfolio that fulfills this condition. How to show that is pretty theoretical. Okay? But think about it really, they can have different stuff. The set does not have to include all stuff. It's not a market portfolio. It's just a companion portfolio. Okay? Good. So if you're interested in the capital asset pricing model, William Sharpe, one of the fathers of the capital asset pricing model, he gave a quite interesting interview on the history of the CAPM, the development, and shares a few background stories. So I recommend you to watch this. And I want to show you the very short version of that. It's just a 1-minute clip where he talks about the capital asset pricing model.
It has to do with the relationship between the price of a security, its risks, and its expected return. And there are really sort of two key takeaways, if you will. One is that in that setting, the most efficient strategy for an investor is to hold basically a broadly diversified portfolio reflecting the market of securities that are available. And that gave birth to the notion of index funds. And the second is that there will be a reward in higher expected return, not guaranteed, but expected, for bearing risk. But the kind of risk for which the reward should be available is the risk of doing badly in bad times. Is the risk of doing bad. The risk of doing bad.
Sorry. So that's how he describes systematic risk, right? I mean, I think that's a very intuitive description. Systematic risk is the risk of doing badly in bad times. If the whole market crashes and you have a high systematic risk, you crash like crazy. If you have a low systematic risk, you'll probably be stable, or even like in the case of gold, move in the opposite direction. So, but I think this is a very nice description of systematic risk. The risk of doing badly in bad times. Very intuitive, very easy to understand. Yeah, that's actually all about the capital asset pricing model. So that's the model. Now we move on to the second very famous theory model, equilibrium theory model, the so-called arbitrage pricing theory. Yeah. But in order to really understand and be able to develop the arbitrage pricing theory, we need to start a little bit earlier and talk about multi-factor models. Okay? So this is what we will do today, multi-factor models. APT we will then do for next time. Multi-factor models are really nothing super fancy, so we already know single-factor models, so they are a natural extension of single-factor models. So that's why we can go through that more or less quickly, because if you understand single-factor models, there's really nothing too fundamentally new about multi-factor models. Okay? So a single-factor model assumes that the overall systematic risk can be summarized by a single-factor M. In the single index model, that's the market index. But you can set up any single factor model, and you can say the single factor is usable GDP or whatever. I mean, in reality, that's again probably not true, right? Because remember, what is systematic risk? That's these are the forces that create co-movement, things that affect multiple all stocks at the same time. So it's probably not only one thing that affects all firms at the same time. There is not only one macro factor or systematic risk. The reality is probably many of them, like GDP news, interest rate news, inflation news, oil prices, exchange rates. You can think about multiple potential factors. So, if all stocks would have the same sensitivity to all of these factors. Like if every stock would have a constant sensitivity to all these factors, I mean, that would be fine. Then you could still summarize that in a single factor. The problem is that, again, this is not true in reality, most likely, because in reality we can have stocks that have a very high risk exposure to one factor, but a very low risk exposure to another factor. Think about, I don't know. I will show you an example on the next slide. And the example will be an electric utility company and an airline. And they will have like very different risk exposures to different systematic risk factors. Airlines are very, very sensitive to economic growth, and utilities are very, very sensitive to interest rates. A single factor model couldn't capture that. So the solution is simply we use more than one factor. It's very simple, just extend it to a multi-factor model. Factor models, keep that always in mind or recall that. I mean, this is not a theory, this is not an equilibrium model. There is no guidance on which factors we use. So everything that constitutes a systematic risk factor, so a factor that creates co-movement among stocks, could be included. So we could do GDP, we could do inflation, interest rates, and so on. And then we estimate the beta, that we also call the factor loading density factor. So if we have a 5-factor model, every stock will have 5 betas, 5 different sensitivities to all of these stocks. Okay? So this allows different securities to have different sensitivities. So if we write it down, it's very simple. This is the single factor model. Again, keep in mind, no theory, it's just a description of return. So the return is the expected part, the macro shock, sensitivity to the macro shock, or specific. Multi-factor model, well, things ER is the same, the term specific part is the same. We just split M in M1 and M. Right? The factor model, you can extend it, 5, 10, 100 factor model. Then we have 2 different betas, or n different betas, and we have n different factor models. Yeah? If we have, as an example, a 2-factor model that uses GDP news and interest rate news as the factors, it looks like this. The return equals the expected return plus GDP news times sensitivity to GDP news plus interest rate news or shocks times sensitivity to those shocks plus term-specific shocks. Okay? So we can decompose the return into this parts.
If we talk with market portfolios, isn't that we can ignore the PI market?
Yes. So this, for broadly diversified portfolios, and this will become actually important in the arbitrage pricing theory, this will go away. Right, that's a good observation. But here, this is just describing returns of single stocks. Think about it like this. Okay, this is not a portfolio, this is a single stock, so we have PI. We are not yet thinking about portfolio. Okay? So again, what is the advantage of a multi-factor model? We can have different sensitivities to different risk factors. So if there are 2 companies, a regulated electric utility in a residential area and an airline. So this electric power utility, this will not be very sensitive to changes in GDP. I mean, if you think about yourself, I mean, even if Hong Kong is doing not so great in economic terms, how much do you save electricity? Probably not dramatically. People still use air conditioning, people still take hot showers and whatever. So electricity consumption and thus the profits of electricity companies are not so sensitive to GDP growth. But they are very sensitive to changes in interest rates because electricity companies, utilities are probably the most capital-intensive businesses. Airlines are somewhat different. Airlines are very sensitive to changes in GDP. So whenever GDP goes up, airlines profit, GDP goes down, airlines up. But they are not so sensitive to changes in interest rates. There are also some sensitivity to changes in interest rates, but not that dramatic.
They are also really like capital have
Right, that's why this example is a little bit, they are also capital intensive, but not as capital intensive as utilities. Just think about the airline in my example here, is an airline that leases its jets. Okay, so that's actually not too uncommon. Airlines, we know from the data, are not so super sensitive to changes in interest rates, they are much more sensitive to changes. Which is not saying that they are not sensitive at all.
And for utility, the government allow them to have like guarantee.
We are talking about an unregulated utility. In a competitive wholesale market.
It's kind of unregulated, wouldn't that be some kind of monopoly because of it?
Yeah, that's a bigger discussion. Think about it in a simple term. There is like a market, and this company sells electricity, and it's just a thought experiment. We will not develop this further. So I just want to show you a few news that are related to that. That's for utilities, where this guy says like interest rates increases are historically bad for utility stocks. They act a lot like the way the bond market does when interest rates rise. Yeah. Typically interest rates go up, so bonds. Stocks of utilities and bonds crash. Airlines really mostly depend on growth, on GDP. So this is not taken from COVID, this is taken from the financial crisis. Airlines can lose 9 billion as they fight to survive. So of course COVID was especially bad for airlines with all the travel restrictions. But even if you go back in time and you look at other crises or other bad economic times, airlines consistently suffered a lot in these times because their revenues decline, less people travel. If people travel, especially companies, they are not allowing their employees to fly business class anymore, which is a big revenue source for the firms, for the airlines. So they tend to suffer. Yes?
But if rising interest rates is another sign of like a recession, that
Yes.
wouldn't it kind of change it?
No, I mean, actually, this is the next one. Those two things are correlated, right? But that's your point. And that's a very good point. So assume that there is macro news about an expansion of the economy, right? So now suddenly people think that the economy will grow more rapidly than we previously thought. For example, there's new unemployment data, and the unemployment data is better than expected, right? So what does that mean? I mean, that means like GDP will go up, but likely also interest rates will go up. Right? I mean, at this textbook, I mean, the last 15 years have been a bit extraordinary, but the textbook idea is that if the economy grows, interest go up to cool down things, and then the economy shrinks, interest go down to cool things up again. Central banks have been not following exactly this pattern in the last years, but yeah. So if that's true, if there's macro news about an expansion, and GDP and interest rates are expected to increase, this would be good for the airline. GDP goes up, also interest rates go up, but the airline doesn't care so much about interest rates. But it would be bad for the utility, because the airline doesn't care really about GDP, it only cares about interest rates. So the whole point of this example is to show that this differential effect on those two companies, we wouldn't be able to capture that in a single factor model. We need a two-factor model.
So under this model, should we see utility companies finance their company during low interest rates and time?
It's just a thought experiment. Don't think too deeply about it. It's just showing different firms have different exposures to different risk factors, and a single factor model is unable to capture that. Okay, that's the whole point of this example. So, what is then the expected return in the multi-factor models? And the thing is, keep in mind that the multi-factor model is not a theory, right? It's just a pure description of the return. So, we do not really have a theoretical foundation that we can use that tells us something about the expected return. But we can, and this is a bit of a stretch, we can borrow from the capital asset pricing model and basically assume that the idea of the capital asset pricing model also holds in a multi-factor model. So the capital asset pricing model tells us that the expected return, the risk-free rate, plus the risk premium for market risk, which is the market risk premium, times the sensitivity of the stock to that risk factor. That is what we learned from the capital asset pricing model, right? So, taking this idea to a multi-factor model, we could now think that, well, in a multi-factor model, what do we get? Well, the expected return should then be the risk-free rate, plus a risk premium for taking the first risk factor, GDP risk, times the sensitivity of the stock to GDP risk, plus the risk premium for interest rate risk, times the sensitivity of the stock to interest rate. This is not a formal proof. Basically what this is just the equivalent of the CAPM result in the multi-factor model. I'm not proving that. We'll actually also not, I will show you a bit more how important or unimportant that result is when we talk about the arbitrage pricing field. Yeah? But that's then the general result would be the expected return is the risk-free rate plus compensation for systematic risk factor. Yeah? So every systematic risk factor would come with a risk premium, and this risk premium is then added to the expected return, multiplied with the sensitivity of the stock to that risk factor. Okay? That's the basic idea. So, again, this is not a proof, but this is the result of the CAPM transferred from one. If the CAPM holds, we could get more or less this result in the multi-factor model as well. So the expected return is then risk-free rate plus risk premiums for different systematic risk factors times the sensitivity. And this also kind of shows you, I said something at the beginning of one of the earlier lectures. Risk premium or systematic risk factors, those are risk factors that cannot be hedged. Right? I mean, systematic risk factors are risk factors that the investor is so concerned about that the investor demands some compensation for that. So if you think about whether something constitutes a systematic risk factor or not, you should think about that along the lines of, can it be hedged or not? Is this something that the investor is concerned about? Is she exposed to it? If yes, if it cannot be hedged and this is a relevant risk factor, it could be a systematic risk factor, and then it comes with a risk premium. Right? Because if we take risk in if we increase the risk, we demand a risk premium. Okay? So the risk premium for each of these systematic risk factors can then be, if you think about it, this is nothing else than the risk premium of a hypothetical portfolio that has a beta of 1 to that factor and a beta of 0 to all other factors. So what is the market risk premium in the CAPM? I mean, this is the premium of a portfolio that has a beta of 1 to the market and a beta of 0 to everything else because it's the only risk factor in the CAPM. Right? So if we have multiple risk factors, we need to be a bit more careful. So the risk premium for GDP risk would be the risk premium of a portfolio that has a beta of 1 to GDP risk and a beta of 0 to everything else. And I will show you next time that actually, even if these theoretical portfolios don't exist because nothing has a beta of exactly 0 to all other factors and a beta of 1, exactly 1, even if they do not exist, this idea is still helpful and we will be able to calculate this risk premium. Okay? But that we will do next time. And the last remark for today, the last important thing for today is that we should be very clear in these risk premiums, they can also be negative. So the risk premium here is not necessarily positive. And there is an intuitive way to understand that. Think about exactly this case here, the risk premium for interest rate risk. The risk premium for interest rate risk actually cannot be positive. Why? Think about a stock that has a positive beta on interest, that has a positive sensitivity to interest rate news. Right? So interest rate goes up. Yeah? This stock goes up. Interest rate goes down. This stock goes down. This is very unusual, right? Typically, interest rates go up, stocks go down, because stocks don't like high interest rates. But if we have a stock that actually goes up if interest rates go up, that's actually great, because adding this stock can reduce this negative risk exposure to interest rate. Our general portfolio will suffer if interest rates go up. Right? That's the usual behavior of stocks and bonds. But if we find one specific stock that behaves in the opposite way, and we add it to our portfolio, then suddenly the portfolio doesn't suffer so much if interest rates go up. It's like an insurance. It's similar to the gold example we had before. So if we have such a stock, we would be willing to accept a lower expected return, again, because it's adding insurance. So if we have a positive beta interest rate beta stock, expected return should go up, down. And the only way that this is happening is that the risk premium is negative. So the risk premium for interest rate is typically negative. The other way is also true. If you have a negative beta, so these are the stocks that move as expected, that have the high risk, because these stocks, interest rates go up, these stocks crash. Right? They have a negative beta, and we have negative risk premiums, so we require more expected return for those types of stocks, because they increase our interest rate risk. Okay? So risk premiums in these multi-factor models, they are not necessarily positive. They can also be negative. Yeah? So the next step is then to take these multi-factor models and develop them into the arbitrage pricing theory, but that we will not start today. So yeah, actually next week we will not have a Friday lecture, at least, because Friday is public holiday. So I will make an announcement tomorrow how we will do that and what we will do next week, but there will be no lecture on public holiday. Okay, we'll make an announcement and we'll do tomorrow. Yeah, thank you and see you next time.